Imagine a man, let's call him David. 68 years old, he worked his whole life and did everything the system told him to do. He paid into his pension every month for 40 years. And somewhere along the way, a financial advisor told him something that felt like the smartest thing he had ever heard. Don't touch the pension. Spend your saving. Spend your ISA. Live off everything else. But leave the pension untouched. Because when you die, it passes to your kids completely free of inheritance tax. So that's exactly what David did. He treated his pension like a gift he was leaving behind, a final act of love for his children. Here is the problem. From the 6th of April 2027, that gift comes with a tax bill of up to 40%, and David has no idea it's coming. If you have got a pension in this country or your parents do, what I'm about to explain is going to change how you think about the next 18 months. Because this isn't a rumor, it isn't a proposal, and it isn't something that might happen. It's already a law. And by the end of this video, you are going to understand exactly what changed, why it could cost some families hundreds of thousands of pounds, and most importantly, what people are actually doing about it before the deadline lands. Let me take you back for a second, because to understand what's being taken away, you first have to understand what you actually had. Back in 2015, the government brought in what were called the pension freedom, and buried inside those rules was something genuinely remarkable. If you had a defined contribution pension, the kind most people have now, where you build up a pot of money and you died, that pot could pass to whoever you had named, and in most cases it sat completely outside your estate for inheritance tax. No 40%, nothing. And if you died before the age of 75, your beneficiaries could often draw that money out without paying any income tax on it either. Think about what that means. For anyone with real wealth, the pension stopped being just a retirement product. It quietly became the single most powerful inheritance tax shelter available to ordinary people in this country. So good financial advisors, doing their job properly under the rules as they existed, started telling clients exactly what that advisor told David. Spend everything else first, run down your cash, your ISA, your investments, but protect the pension at all costs, because it's the one thing you can hand over whole. And here is the thing I want you to really sit with. That was completely rational advice. Under those rules, it was the right move. Millions of people built their entire retirement and inheritance plan around it. They weren't being greedy, they were playing the game by the rules they were given. Now here is what nobody told David. In the autumn budget of October 2024, the Chancellor announced this was ending. And in March 2026, it stopped being an announcement and became reality. The Finance Act 2026 received royal assent. That's the formal moment a bill stops being a proposal and becomes the actual law of the land. So I need you to hear this clearly. This is done. It's not under consultation anymore. It's not up for debate. It's locked in. From the 6th of April 2027, most unused pension funds and death benefits gets pulled back into your estate for inheritance tax, which means the pension David was told to protect now gets added to the value of his house, his savings, everything he owns, and the whole lot gets assessed for inheritance tax together. Let me pull real numbers on this, because this is where it stops being abstract. Everyone in the UK has what's called a nil rate band. That's the slice of your estate you can pass on with no inheritance tax at all. It's £325,000 and it's been frozen at that level, with the freeze now stretched all the way out to 2030. On top of that, there is an extra allowance called the residence nil rate band, up to £175,000 if you are leaving your main home to your children or grandchildren. Put it together and a married couple can potentially pass on up to £1 million tax free. Everything above that line gets taxed at 40%. Now, the government is very keen to point out that more than 90% of estates won't pay a penny of inheritance tax even after this change, and that only around 8% of estates are affected. And that's true, but here is the part they say a lot more quietly. HMRC's own figures estimate that this single change drags roughly 10,500 extra estates into paying inheritance tax every single year. Families who under the old rules would have paid absolutely nothing. Picture a retired couple in the southeast, a home worth £650,000, pension pots between them of let's say £800,000. Under the old rules, those pensions sat outside the estate, and with their allowances, the whole lot could pass to their children tax-free. Under the new rules, those pensions gets added straight back in, and suddenly a large chunk of that estate is sitting in the 40% zone. That's potentially well over £100,000 in tax that simply did not exist for that family 18 months earlier. Same family, same money, different rules. But I want to show you the part that genuinely shocked even people in my own profession, because there is a second layer here that a lot of the headlines got slightly wrong, and I'm not going to let you walk away with a number that isn't accurate. Remember I said if you die before 75, your beneficiaries can take the pension income tax free? The flip side has always been that if you die at 75 or older, they pay income tax on whatever they withdraw at their own marginal rate. That rule isn't new. What's new is that from 2027, you stack inheritance tax on top of it. So when this was first announced, the tax specialists at firms like Deloitte ran the math. They came out with a frightening figure: 40% inheritance tax and then up to 45% income tax on what's left. And when you combine the two, you get an effective tax rate of around 67%. 67 pence out of every pound gone. That number went everywhere. It's a big part of why a petition against this attracted tens of thousands of signatures. Now, here is where being an accountant actually matters, because I want to give you the precise version, not the scary one. The final legislation softened the very worst case. The way it works now, the slice of the pension that gets eaten by inheritance tax doesn't then also get counted as taxable income on top. So you are not literally taxed twice on that exact same pound. That genuinely takes some of the sting out compared to the original 67% headline. But, and this is the honest truth, it doesn't make the problem disappear. You can still be looking at a combined effective rate comfortably north of 50% for a higher or additional rate taxpayer inheriting a pension from someone who died after 75. The real story was never the headline 67%. The real story is that the pension you assumed would reach your children almost whole could, in the worst cases, arrive with more than half of it stripped away. And almost nobody has actually run that calculation on their own family. Now, I want to step away from numbers for a moment, because there is a reason this particular change makes people so furious, and it's worth understanding properly. There is a famous piece of research by two psychologists, Daniel Kahneman and Amos Tversky, who basically founded the entire field of behavioral economics. Kahneman went on to win the Nobel Prize for the work. One of their core findings was something called loss aversion. And in plain English, here is what they discovered. Losing something hurts roughly twice as much as gaining the same thing feels good. The pain of losing £100 is about double the pleasure of finding £100. We are wired deep in our psychology to feel losses far more intensely than equivalent gains. Here is why that matters here. People weren't handed a worse deal on some brand new product they were thinking about buying. They were promised something, a tax-free pension hand down. They built their plans around it, in some cases for over a decade, and then watched it get taken back. That's not a missed gain. That's the loss of something they already believed was theirs. And loss aversion explains exactly why this lands like a betrayal rather than a policy tweak. The feeling is real and it's completely valid, but here is the danger. When people feel a loss that sharply, they panic. And panic is precisely where the genuinely expensive mistakes get made, because there is another problem hiding underneath all of this that barely anyone is talking about. And it's got nothing to do with the rate, it's about who actually has to deal with it. Under the new rules, the people legally responsible for working out and paying this tax are your executors, the family members or friends you name to sort out your affairs after you're gone. The legal term is personal representative. So picture this. Your son or daughter grieving is now legally obliged to track down every pension you ever held, get each one valued, work out the inheritance tax due, and pay HMRC. And under the rules, that payment is genuinely due within the 6 months of death. The government was specifically asked to extend that deadline to give grieving family more breathing breathing room. It was refused. And here is the trap inside the trap. The tax is due on the pension, but the pension money is sitting with the pension company, not with your executors. So you can end up with the situation where your child owes HMRC a small fortune in tax on a pot of money they can't yet easily get their hands on. The law does provide a release valve. Your executor can send a formal notice to the pension scheme telling it to pay the tax straight to HMRC out of the pot. And the scheme then has 35 days to do it. But that's a process, paperwork, deadline, valuation, and real penalties if it's handled wrong. The simple, clean inheritance people pictured is quietly becoming an administrative minefield. So what are people actually doing about it? Predictably, a lot of them are panicking and pulling money out of their pension right now, trying to get ahead of it. And this is where I have to be an accountant in the room and slow you down. Because for a lot of people, this is the single worst move available. The moment you yank a large sum of your pension, you can trigger an income tax bill today at your highest rate. And you throw away all the tax-free growth that money was earning while it sat in there. You can very easily do more damage running from a future tax than the tax would ever have cost you in the first place. So let me give you the reframe, the way I genuinely want you to think about this. For the last 10 years, the smart money treated the pension as the inheritance vehicle and everything else as spending money. The honest read of these new rules is that you may need to flip that thinking completely on its head. The pension is once again becoming what it was always meant to be, a way to fund your own retirement and your own life. And the job of passing wealth to your children moves to different tools entirely. Before I run through those, I need to say this plainly because it matters. Everything I'm about to describe is general education, not personal financial or tax advice. Your situation is yours. The right move depends on your numbers, your age, your health, your family. So please, take this as a map of the territory and then sit down with a qualified advisor about your specific circumstances. With that said, here is what's genuinely on the table. The first one is almost embarrassingly simple. You may now want to actually spend your pension. If you have spent your life hoarding it to pass on, the logic has reversed. Use the pension to fund your retirement. Enjoy the life you paid for and preserve other assets for your family instead. An ISA, for example, still passes far more simply, and money you have drawn out and given away can move out of your estate entirely. Which brings us to gifting. UK rules let you give money away while you are alive, and as long as you live for 7 years after making the gift, in most cases it falls completely outside inheritance tax. So one approach people are now seriously looking at is drawing a sustainable income from the pension and using some of it to help their children while they are actually around to see it. A house deposit, a wedding, a grandchild's education, rather than leaving one big lump sum to be taxed on death. Then there is the spousal exemption, which a surprising number of people forget exists. Anything you leave to a husband, wife, or civil partner passes completely free of inheritance tax, and that has not changed. The catch is that it only delays the problem rather than solving it, because the bill tends to land on the second death when everything passes down to the children. But it buys time, and time buys planning room. For the charitably minded, there is a quite incentive backed right into the system. If you leave at least 10% of your estate to charity, the inheritance tax rate on the rest actually drops from 40% down to 36%. And gifts to charity straight from a pension stays completely tax-free. And finally, for families with really substantial pots, there is a tool advisors have used for generations. A whole of life insurance policy, written in trust, designed to pay out the exact size of the future inheritance tax bill. Done properly, your children inherit the pension, the policy covers the tax, and the policy itself sits outside your estate. It's not for everyone, but for the right family, it's surgical. None of these is a magic trick, and I want to be honest about that. The point isn't that there is some clever loophole. The point is that doing nothing, leaving in place a plan that was built for rules which no longer exist, is now itself a decision, and it could turn out to be a very expensive one. So here is what I want you to do. If this was useful, subscribe, because this is the third part of a series I'm building on the hidden tax traps quietly draining UK households. I have covered the 60% tax trap that ambushes you when you earn over £100,000 and the £50,270 salary trap that almost nobody sees coming. This one completes the picture right at the other end of the line. And do me a favor, drop a comment and tell me honestly, did you or your parents ever get that exact advice to protect the pension and spend everything else? Because because I would put money on a huge number of you having heard precisely that. And share this with one person who needs to hear it before 2027. That's genuinely how this channel grows and how more families get ahead of this while there is still time to act. This is Mr. Financial Mindset. I'm Muzaffar Teja, reminding you, you weren't born to pay bills and die. You were born to understand the rules well enough that no one, not even Taxman, gets to write the ending of your family's story for you. I'll see you in the next one.